Welcome to On My Way to Wealth, the podcast where busy Gen Xers can learn financial tips as they navigate life on their way to wealth. And now, please join your host, Luis Rosa.
Hello, everyone. Welcome to episode number 73 of the On My Way to Wealth podcast. We're making our way towards 100 pretty soon here. Thank you all for tuning in. My name is Luis, and I'm your host. How does the Federal Reserve raising or lowering rates impact your finances? You probably heard very recently how the stock market was worried about inflation, and you also hear the word, the Fed. And, a lot of people always ask me, like, what does all that mean? So I wanted to make an episode about that just to give you a quick rundown of exactly who the Fed is and how it impacts things like the prices of something that you might borrow, like to buy a car, buy a house, things like that. So a lot of their actions have a lot of impact into the things that we do every day. So I wanted to give you a quick rundown so that you can also do some proper planning around it. I promise to try not to bore you to death with all these economic terms. I was a major in economics. For those of you that don't know, I have a bachelor in economics, and I used to love this stuff. So I will do my best to make it as simple and as the least boring possible. But bear with me for a second because there are some key terms that I first must tell you about so that then you understand fully how they impact the economy, the stock market, and then overall finances, right? So the first thing is, what is the Federal Reserve System? Who is the Fed? The Federal Reserve System is often referred to as the Federal Reserve. Some people call it the Federal Reserve Bank. Some people just call it the Fed. Basically, it is the central bank of the United States of America. It was created in 1913 by President Woodrow Wilson when he signed the Federal Reserve Act into law. And what it does is four main core areas, but in essence, the mission of it, the reason it was created, it was to provide the nation with a safer, flexible, and stable monetary and financial system. And I'm going to tell you a little bit how they do that. They conduct the nation's monetary policy by influencing money, and they try to also impact credit conditions in the economy, and also try to attain what they call full employment and stable prices. So the four main core categories is supervising and regulating banks. It's one of the things that they do. The other thing is maintaining stability of the financial system, including try to contain risk as it arises in the financial markets, providing certain financial services to the U.S. government and other U.S. financial institutions, and also to foreign institutions as well that play a major role in operating and overseeing the nation's payment systems as well. So that's the core of the Federal Reserve and like the mission. So when you hear that they raise rates, I'm going to tell you exactly what that means and how it impacts your finances. First of all, I want to tell you a little bit about inflation. You might hear that word, again, bringing me back to my college economics days. In a very short sentence, inflation is just the decrease in the purchasing power of money or the increase in the general prices of goods and services in an economy. So, for example, think about something that you use every day. If you drive, maybe a gallon of gas. If you do food shopping, perhaps a gallon of milk. Think back 10 years ago. How much was that thing that you use today? And it could be anything. Typically, gas is a good way of looking at it to things like gallon of milk, certain goods and services. There is the Consumer Price Index that is published by the Bureau of Labor Statistics, and they break it down into how prices have moved throughout the years. And they also have different goods or baskets because not everything goes up at the same rate, So something like college or medical expenses might rise a lot faster than the general goods of the population, right? But in essence, inflation kind of creeps up on you over time. You don't feel it as much. So when you're saving money in the bank, you feel some sort of safety net because if you have your money in the bank, it doesn't go down in value because you don't have it invested, right? So if you put $10 in the bank today, 2 years from now, you'll still have those same $10, maybe a little more with a little interest, right? Now, here's the problem with that. prices are going up faster than the rate of return that you're getting on that cash. And it doesn't mean that you shouldn't have cash in the bank. I always recommend that you have your emergency funds in the bank because you need easy access to them, which is super important, right? So you don't want to take a risk with the money that's supposed to replace your income in case you lose your job or something happens, an emergency, family death, et cetera. So that's why it's okay to have the money in the bank, preferably in a high yield savings account so that you're at least getting some sort of interest while it's there. But what happens is prices keep going up. So I always used to use this example when I talk to people. I'm from New York City, so there were a token, back in the days when you had an actual token to ride the subway. So I remember the cost of those. I remember when I started driving as well, the price of a gallon of gas, So I will go back to say 1990 and tell people, remember where a gallon of gas was around 1990? I think it was around $1 somewhere. So I tell people, if you had $1 in the bank back in those days and you left it there, and then you went to take that dollar out today, you probably have like $1 something, right? Because you gain a little interest in the bank, but it wouldn't be enough to buy you a gallon of gas today because gallon of gas right now is over $4 where I'm at in California. So that's what happens with inflation. So the Federal Reserve tries to contain inflation as much as it can because inflation going up, the cost of prices going up has a negative effect on the economy because then people tend to not spend as much. If obviously there are certain necessities that you still need to get, but there are certain items that if they go up in price, like cars and things like that, you may just not go out and get them. So it's always about stimulating the economy, but also keeping a leash on inflation going up as well. So what gets impacted by inflation? Things that are future purchases. If you're thinking about it, buying a home, your retirement, because you're going to have expenses. If you need $3,000 a month to live on today, that may be $3,800 10 years from now because prices go up, right? So that's one of the things I do as a financial planner is when somebody's talking to me about retirement, for example, we look at the cost of inflation. If we're talking about college savings and your child is just like 2 years old, we have to take into account what a college costs today, but also what rate of inflation is education going up by so that we save enough so that by the time your kid is ready to go to school, you've saved enough to have the ability to pay for that school because it's going to be very likely a lot more than it is today, right? So what is the federal funds rate and how does it affect the economy and your finances? So the Federal Reserve sets the rate for what's called the federal funds rate, and that's what they raise. When you hear that the Fed raise rates, they don't raise anything directly in terms of what affects you. They don't raise car loan rates. They don't raise mortgage rates. The Fed doesn't do that. What they do is they raise or lower the federal funds rate. Every bank is supposed to keep a certain amount of reserves overnight, whether it's with the Federal Reserve or in their own vaults, because banks typically lend out a very large portion of the money that is on deposit. So if right now, as you listen to this, everybody went to the bank at the very same time and demanded to get all of the cash that's there, very likely the bank will not have that on deposit. Because what happens is when you put your money in your savings account, the bank has to make money, right? So they give you a little interest, but then they lend it to me as a credit card, or they lend it to your neighbor as a car loan or a business loan, et cetera, right? And that's how they make their money, by lending your money out to other people. That's part of it. So if everybody went to the bank at the same time, very unlikely that that particular branch is going to have all the money in hand. However, the Federal Reserve requires that each bank keeps a certain amount of reserves so that they don't lend all of their money out. Because I feel like if you let them, most banks probably would. So what it does is a lot of banks then fall short of their reserves and they realize it that day. So then they have to borrow overnight. And that's what the federal funds rate comes in. Banks even lend each other money and at the federal funds rate. Now, what happens then is when the Federal Reserve, for example, let's say they lowered the Fed funds rate, money becomes cheaper to these banks. And in essence, then they pass those savings along to you. So now they know, okay, you know what? Our costs went down as a bank. Well, now I can lend car loans at a lower rate. I can lend credit cards at a lower rate. I can lend adjustable rate mortgages at a lower rate. So every time you hear that the Fed lowered rates, that eventually will have a direct impact on a lot of the stuff that you already have, like your credit cards, student loans, things like car loans, things that you get directly from a bank, right? Not long-term mortgage rates, because long-term mortgage rates are not necessarily impacted by the short-term rates. They're more either the 10-year treasury and other things that are happening in the economy. Mortgages are sold in the secondary market, so there's also like a whole system behind that as well. So it doesn't necessarily impact your fixed mortgage rates. It does impact your adjustable mortgage rates, because those are impacted by short-term rates that the Fed raises or lowers. So what happens is when the economy seems to be like slowing down, the Fed then lowers interest rates, and that encourages consumers to borrow more and spend more. Businesses then do more selling, they do more hiring because they're doing more selling. And then it stimulates the economy, people get paid, they go out and spend more money, and so on and so forth. So when inflation is going rampant, the Federal Reserve then goes and raises rates because prices are going up too fast. And what happens is they try to slow down the economy by raising the rates that the banks charge each other. And in essence, the banks are going to raise the rates they charge you for car loans. And then that slows down the pace of the economy. People borrow less money, companies sell less, and so on and so forth. Now, that has an impact on the stock market, because if companies are selling less, their profits are going to go down. Obviously, this doesn't impact financial institutions, but it does impact other companies, right? So from a stock market perspective, so the stock market typically would price in or react very quickly to Federal Reserve moves. The economy might take a while for you to see like the effect of them either raising or lowering rates. So that's when you hear, as an investor, you hear that the stock market isn't doing well because of inflation concerns or the Federal Reserve raising rates. They immediately think, okay, the Federal Reserve is raising rates. That means that people are going to borrow less money. There's going to be less economic activity. Companies are going to make less. And in essence, the prices of those stocks will go down. And that's why the stock market reacts that way when that happens. So if interest rates are cut, certain types of borrowing can become more affordable. Credit cards, vehicle loans, adjustable rate mortgages, home equities line of credit as well. So people are encouraged to spend more money. Now, falling interest rates have two bad sides. One bad side to it. One is the good news is that things go down in terms of money that you borrow. However, if you have money saved, that too gets impacted, like in a savings account, a high yield savings, or a CD. So if you've noticed, if you've ever had something in a savings account, money in a savings account, when rates were high, you were getting more of a return on the high yield savings. I remember one of the banks that I use, I was getting a little bit over 2% on my high yield savings account when I first started a few years ago with that bank. And now it's only like 0.5%. And that's because the Fed funds rate is so low. So that has a direct negative impact on your savings. So if you are a saver, you're not going to be happy when the rates are down. If you are an investor, you will be, because if rates are low, people borrow more and companies sell more, hire more, and so on. There's good economic stimulus. So it depends on what side of the fence you're on. And you might be all, right? You might be a borrower, a saver, and an investor at the same time. But these are the kind of things that you may have to weigh in, because they might affect you in terms of like buying a home. You have to weigh the options depending on how long you want to stay there. Should I do an adjustable rate mortgage? Should I do a 30-year fix versus a 20? And these are the kinds of things that you can talk to a financial planner about. And by the way, I don't know if you know this or not, but I do offer a complimentary 30-minute consultation. It's all about you. And if you have any questions specifically that you might want to just run by me, I'll give you my professional opinion. Just go to onmywaytowealth.com and click on work with me, or go to buildthebetterfinancialfuture.com and click on schedule a call. No commitment of any kind, just schedule it. We have a talk. You tell me what's on your mind, see if I can help you in any way, and I'll be happy to do that. So be sure to check that out, take advantage of that opportunity. So now you know how it impacts the stock market. Now you know why, you know how it impacts your everyday things like credit cards, car loans, student loans, other debt, and you know how it impacts short-term mortgage rates as well. So it depends on what side of the fence you're on. It'll make you happy or sad based on if you're borrowing or saving or investing, right? So I hope that you found this useful and hopefully not too boring with all this economic jargon. So feel free to reach out to me if you have any questions, if there's a topic that you'd like to see in the future, if you have someone that you'd like for me to interview, want to make a connection, I'm always open to that as well. And again, if you'd like to just have a complimentary 30-minute consultation where we just talk about whatever is on your mind, any decision you need to make, or just have a question about your finances, I'd be happy to just sit down with you for those 30 minutes. And we could do that virtually via Zoom. So you just go to my website, buildthebetterfinancialfuture.com, schedule a call, or onmywaytowealth.com, click on work with me, and then you'll get the link to schedule a call. So I hope all is well. Thank you for tuning in, and I'll see you on the next episode. Thank you for listening to On My Way to Wealth. If you have any questions, please send me an email at luis@onmywaytowealth.com. The information provided here is for information and education purposes only. The opinions expressed herein are solely those of myself, unless otherwise specifically cited. Material presented is believed to be from reliable sources, and no representations are made by my firm or myself about other parties' information or accuracy or completeness. All information or ideas provided should be discussed in detail with a financial advisor, accountant, or legal counsel prior to implementation. Thank you.